versus the qualitative, then you need to think carefully about this topic with regard to the exam and potential exam question. If you like more qualitative, less quantitative, this is a good topic for you. And in that regard, you will see this subject matter will typically appear in section B of the exam. When you look at the past exams, this is always in section B of the exam, not section A. As we've said before, section A tends to be problem solving or quantitative type of work. Okay, so each of you will have their own opinion about whether they prefer quantitative or qualitative. If it is qualitative, this is a good topic for you. So we're going to briefly really discuss the idea of efficient markets hypothesis, because I know many of you would have come across it before. What we want to focus much more on is some of the implications and eventually for portfolio management implications. And then we want to look at some of the evidence which is for and against this idea of efficient markets. And then finally we come to the topic of behavioral finance, which would be regarded as an alternative way of thinking about how markets operate. So to begin, the word efficient, this is not the first time we've seen the word efficient, and unfortunately each time it's got a slightly different focus or meaning. So we spoke about efficient in topic 1 5 weeks ago now already, but what were we thinking of as being efficient when we spoke about the role of financial markets in topic 1? No, we didn't mention efficient market hypothesis in topic 1. No. Efficient portfolios, that wasn't in topic 1, but yes, it's still the same word, efficient. Yeah. Investment, yeah. Not instruments, no. I'll tell you. We use the phrase efficient allocation of resources in topic 1. So we have a notion which is called allocative efficiency. Allocative efficiency. How does a financial market allocate resources, meaning funding for companies or funding for governments? So that was one way we used the word efficient in topic 1. So that is allocative efficiency. You already mentioned efficient portfolios. Again, that's completely different from what we're going to talk about today. So, efficient frontier, efficient portfolios, we'll be talking about in topics 3 and 4 especially. So that meaning of efficiency is about choosing portfolios, choosing optimal portfolios. Now, we might see efficient markets. We might also think of another idea of efficiency, which is operational efficiency. You might think of it as the exchange and how efficiently does the exchange operate, as if you were talking about any business. Does it manage its costs well and so on. So please be careful that there's all these different uses of the term efficient or efficiency. They all relate to financial markets. And all of the three I've just been mentioning are all different than today's meaning. Because today's meaning is about information. So today is about informational efficiency only, not the other types of efficiency. Only informational efficiency. So that means, what is the connection between market prices and information? That's what it means. Or that's what it's referring to. So the connection between stock prices or bond prices or exchange rates and information. What kind of information? What kind of information has any relevance to the stock price or to the bond price or to the exchange rate? History of prices, yeah. So for today's price, what was yesterday's price? Or what was last week's price? That's information that's connected to today's price. Yes, definitely. What else?
Political information.
Yes, political variables. Yeah, definitely. So it might be something to do with political stability, or it might be elections. You know, all of those kind of things have a connection to market prices. You know, stock markets go up when a certain election result happens, or stock markets go down when there's some change of government in some other way. Okay, so yes, definitely political type information. You could have a label. What are the labels? Past prices, the political.
Merger and acquisition or takeovers news, or the annual report of any industries. At the end of the year, like how's their prediction, like how's it going to be their like growth rate, or how is their performance at the last quarters. So quarterly those can affect the markets as well.
Okay, so you've got at least two things there, maybe more, but mergers and acquisitions, so companies restructuring in some way, definitely, you know, the announcement of merger or the expectation of a takeover always have an effect on stock prices. And you started talking about annual reports. Well, that's getting us into the whole arena of accounting information. Obviously, stock prices and corporate bonds have a strong connection to accounting type of information. You mentioned the prospects or forecasts for the business and so on, but there's other things, sales, revenue, growth, profitability, all kinds of things from the accounting domain. There's one more group, the dividends. I would put the dividends under the reporting and accounting group, if you like, of information. There's one more category that we used last week, a big category that we used last week. Yes, news in the media about what though? We talked about news about accounting, news about political.
Systematic risk.
Okay, systematic risk arising from what? Yeah, macroeconomic news is the last one I'm looking for, yeah. Okay, so obviously we have reports. What is the inflation value for this month? It's a scheduled announcement. It's a specific time of day on a specific date when we know the latest inflation or the latest GDP or the latest unemployment numbers. It doesn't just appear somehow, it's a scheduled announcement. It will be at 9:30 precisely on the 10th of this month. Yeah? So macroeconomic news will move financial market prices as well. So think about those types of news, the accounting type, the macroeconomic type, the political type, and the past prices as well. All of those are potentially information that we might think of today. So what is this word now, anomalies, then? If we just think about it as a word in English language, what does anomaly mean? Something unusual or something abnormal. So here it's going to be some kind of behavior in a financial market which is not explained by the hypothesis that we put forward. So we put forward an idea of informationally efficient markets, and an anomaly then will be some evidence or some price behavior which is not supporting that. That's what we're going to refer to as anomaly. Okay, then behavioral finance is about decision making and investor psychology. And we're going to come to that in the last section. Okay, so this is the outline. We're going to briefly talk about the hypothesis from which we start, EMH, efficient markets hypothesis, but we'll quickly move on to think about the evidence on this hypothesis, and also some important implications, especially in portfolio management or fund management. So I want to draw attention to that. And then after the break, we discuss some anomalies, which means we're going to see some evidence which is contradicting the hypothesis, or some evidence against the hypothesis, if you like, in more detail. And then if we look at evidence against the hypothesis, we might have to think, what other hypothesis could we have if there's a body of evidence which is against the first hypothesis that we set up? And that leads us into an alternative known as behavioral finance. Okay. So I'll just set out the basic idea of this hypothesis, EMH or EMT, efficient market theory or efficient market hypothesis. So clearly you can see information is immediately the word that comes up here. So we're talking about whether the prices react to new information, do the prices reflect the whole political, macroeconomic, accounting information which is relevant. So you can find many definitions of this hypothesis in different books and articles, but this is the one which is favoured, and certainly favoured by me. The market, we're going to call it informationally efficient if you can't make profits on the basis of trading on that information set. We have to be careful with the word profits, which is to say that you will get a return, but it's a return relative to the risk level, so it's still consistent with our previous weeks, that the return is going to be somewhat commensurate with the risk that you take. And so we should really say excess return or excess profits rather than no profits at all. Okay? So that means if you have this information about merger, takeover, you said, even if you know about this takeover that was mentioned before other people, then you still couldn't make an abnormal or excess profit from knowing that before other people. Okay? So that's a pretty demanding statement to make. You may be surprised that if that's the case, that it would be true. So it's a pretty challenging hypothesis to set up. To say, even if I know before you there's an acquisition of company B by company A, I still can't make an extra return or extra profit compared to everybody else. So it's a big statement this hypothesis is making, really, by saying you can't use that information to make extra profit or return. So there's an idea, therefore, that there's some equilibrium price or fair price at all times for each security or each exchange rate, if you like, and that investors are looking at all the information that's available. They are trying to seek out above normal returns or excess returns, trying to outdo each other, if you like, and that this produces the outcome of an equilibrium, which is a fair price and a fair return, therefore, for the amount of risk we take. Okay, so that's the idea, but it's still pretty demanding, like I say, that that certain information could not be used to your advantage as an investor if you had that information before others. It's a pretty challenging statement it sets up, really. So how do we get to some equilibrium? Well, there must be some forces at work here in the market, supply and demand, and if you think maybe about the pension fund manager or the mutual fund manager, what are they trying to do? If you're running a mutual fund or you're running a pension fund, what would you like to achieve? less profit, but you would like to have better profit or better returns than your competitors, than other mutual funds or other pension funds. You would like to do better than them, wouldn't you? What will happen if you do better than the others? You'll attract more customers, you'll attract more clients, you'll attract more funds, and if you, for example, you're paying a percentage fee, then the more funds, the more absolute revenue there will be for that manager. Yeah? So it is envisaged, shall we say here, that all these different investors, like fund managers, are competing, looking for the best information, looking for above normal profits, and that's the way that we might reach this equilibrium. So it doesn't say that, you can't make profit, you can't make returns, but this fair or equilibrium price will give you some normal level of return, and this normal level of return is pretty consistent with what we've talked about in the previous 4 weeks, really, that we've tried very hard to connect the return with the riskiness, as you know, from the previous topics. So we're not throwing that away, but we're just phrasing it slightly differently perhaps here, that there's some normal level of return for that level of risk, and if the market reflects all the relevant information, there won't be any extra return above that. Some people, quite often make the mistake that it does mean absence of return. You can't make money, you can't make returns because of this hypothesis. That's not right, okay? It's, there is a normal level of return rather than an abnormal or excess level of return. That's what it's saying. So also, it doesn't say that the market will be exactly efficient, if you like, all the time. There will be not 0, not efficient, 1 efficient. It won't be that simple. There may be some grades of efficiency or some levels of efficiency. More or less efficient doesn't mean 2 categories. Not efficient and efficient do more than 2 categories. So sometimes you will find opportunities where you can do better than normal. So my last bullet point here, beat the market. What does that refer to? The term of beating the market. Outperform, yeah. Well, could be speculation, but the outcome is what we're focused on here. Beating the market with the outperformance is the right word. Outperforming what? You may have more information, you may have better information. Yeah. So if you so-called beat the market, as I put in quotes here, it means you are an investor or a fund manager, and your performance in terms of returns to risk is better than your peers, or it's better than a benchmark, or it's better than average, if you like. So of course that will happen, if you've got an average performance, some will be above and others will be below for a given time period. You can't have everybody being exactly average every period, there's a distribution of performance every period. But what it does say is those who are above average, or those who are top in the list of fund manager performance, won't be the same ones each year. That's what this hypothesis was saying. Okay, so you've got a chance of being above average this year, and you've got a chance of being below average. But if the market is efficient in an informational sense, it shouldn't be possible for the same manager or the same fund to be top of the list every year, one year after another. So that we would call persistence. Persistence of outperformance is not expected here. Persistence meaning continually doing better than average. Should it happen if this hypothesis is holding or correct over, the medium term or long term? So, just in case can't be heard at the back, you know, the question is, don't entities like hedge funds do that, beat the market? That's what they're trying to do. Well, it's not only hedge funds who are trying to beat the market. Every mutual fund or pension fund would like to beat the market for the reasons that we said. You beat the market, you get more clients, you get more money to manage. So it's not only hedge funds. But it's not only about the return or the profits, it's still about the risk as well. So normally a hedge fund will be taking more risk. But also, if you look at the evidence, it's not true. I mean, many hedge funds have gone out of business because they failed. Yeah, only to close down. You know, so you can't suggest that every hedge fund is successful by any means. You know, if you look at the number of hedge funds in the world in 2006, 7, 8, what do you think happened? Collapsed. The number collapsed because they were shutting down and failing. Okay, so I don't think hedge funds are somehow superior in that sense. The best hedge funds, okay, that's a different matter. But just being a hedge fund doesn't matter. It doesn't mean you're going to outperform. Doesn't mean you're even going to survive. Well, no, they won't go out of business for being below average for 1 year or 2 years. You know, they may lose some clients, but they're not going out of business. They won't lose every client by being below average 1 year or 2 years. No. You know, if there's 100 hedge funds, they can't all be above average. So here I'm alluding to the fact, like I said, that don't have it in your mind, inefficient, efficient, as if those are the only two categories. It's not the case. You know, there are many categories. So here, you might suggest 4, not 3, because over here you might say inefficient, which means the price doesn't reflect any information. Do we think that's possible? No, I mean, that would be implausible in the modern world, that prices in financial markets don't reflect any information. So profit of a firm is irrelevant, GDP, inflation is irrelevant. That would be just ridiculous to claim that. So the first level here, in the top box, you suggested past prices. So, you know, you could argue that's the most basic level of information, the past prices. There's nothing sophisticated about that. It's just telling you what was the price yesterday, what was the price the day before, and so on. Historical prices, like we've used sometimes when we calculate returns and so on. So in that box top left, we're just saying, in the information set, we're only thinking about the past prices. Okay? So that means, like I said, yesterday's price and last week's price, and so on. So in the financial markets, who uses past prices as their information set? Analysts, yeah. But if they only use past prices, they're called technical analysts. Technical analysts. Okay, so a technical analyst is looking at charts, is looking at price patterns, looking at price trends, and coming to conclusions about when to buy and sell based on charts. So they're also called chartists. Chartists, that's what they do. They look at charts and they look at patterns. So they believe, if they do that, that there's something in the past price that tells them is the price going up or down today or tomorrow or next month. That's what they believe, otherwise they wouldn't do it. Okay. But if the prices already reflect that information, then that approach is going to be unprofitable. It's not going to deliver excess returns. So that's called the weak form of efficiency in this hypothesis. So the weak form says prices already reflect the past information. You can't create, an above average performance in your fund by using technical analysis, if that's defined as using just charts and just price trends. So already that's a big statement, even though we're only calling it weak efficiency, because how many people in practice are doing this? Hundreds, thousands around the world. Many, many thousands of technical analysts around the world. So they don't believe this. They believe they can make extra profit by looking at the past prices only. We'll come back to whether that's right or not in terms of evidence in a few minutes. Now, we come to the second level of information and the second level of efficiency, which will be called semi-strong. So if you start with the past prices and then you add something, which is publicly available information, what would you be adding? So from the box on the top left to the box in the top middle, what have we added in terms of information? Yes, for example, give me one time. Okay. Okay, so that goes back to what we said earlier, political information, mergers and acquisition information, accounting information, macroeconomic variables. Okay, so those are all publicly known. When the Statistics Agency releases the latest inflation numbers, everybody knows. It's not a secret. It's a secret until the moment it's released, or at least it's supposed to be. And then everybody can know it. It's in the public domain. So who uses that type of information? Well, that's fundamental analysts, fundamental analysis. Fundamental because it's using real information, if you like, accounting information, macroeconomic information, hard information, if you like, mainly because it's objective, it's quantifiable type of information. So if the prices are already reflecting that publicly available information, then this again is going to be unable to draw excess returns or profits from trading. Okay. Again, that's a very big statement because, again, tens of thousands of people are employed to do fundamental analysis. So to make this statement, they're wasting their time is a big statement to make. So again, we'll have to think about evidence on that in a moment. And then finally, this is the column where you say efficient. So if you like, this is the extreme, which is to say now all information. So what's the difference then? What have we added between the top middle and the top right box? Secret, yes. Well, the word we'll use is private. Okay, private information. So if you are the chief executive, obviously you know things that other people don't know about the company. If you are the finance minister, you know things about the country's finances that not everybody knows in the market. Okay, so if you're the person who knows the acquisition is going to happen before everybody else knows, that's private information again. Okay, so this is a higher level of information again because that's obviously going to be a much more restricted group of people who could know that. So one example would be insiders, like we say, the chief executive or other members of the board of a company, they're insiders. So even if they use their information to trade, because they know there's good news coming or they know there's bad news coming before investors know, in this level, if prices reflect all information, then even this trading is unprofitable, doesn't deliver excess profits. So that is a challenging statement to the point of being possibly not believable, yeah, because it's so at the extreme level of efficiency with regard to information. So this is called a strong form. Obviously, that's a strong level of the hypothesis that is being stated.
Insider trading, but it's not profitable. Like if you have like information and you're the CEO and you're reflecting on that information by yourself or anyone your relatives or close people, that's illegal, isn't it?
Yes, so you could turn your question around to say, if the strong form is true, why do we bother with rules and regulations about insider trading? Yeah? So we do have rules and regulations to stop insider trading, to stop that kind of abuse, we call it market abuse as well. If you know the information because of your privileged position and you use it to profit personally, that's abuse of the market. So the third level, in that regard of insider trading is not, permissible, as you say. Right? So it's the extreme level of thinking about whether the information can all be reflected in the price. So what I want to do is, apart from setting out this as levels of efficiency, is obviously to think about the evidence and the implications. So that's going to be the main focus in the next part. One further suggestion here, I've already made the point, it's not a case of a fixed efficiency. It's not the case the London Stock Exchange is efficient, and therefore it's always efficient, and it's always strong form efficient. That's not how we should interpret it. We should think a bit more openly and say, well, the level of efficiency can change over time, and one market may not necessarily say is that level of efficiency and will always be that level of efficiency. To give you an example, you might see in the past some markets that we may call emerging markets. You may find some quite easy profits to be made from investing in some less developed markets. Over time, many of those markets have become more informationally efficient. No longer so easy in some such markets to make excess profits, or what you might call relatively easy returns in the lesser developed markets. So that's an example, efficiency improving over time. The market becomes more sophisticated, there's more international investors, there's more information flow, there's more transparency of the government. So all those kind of reasons in emerging markets can lead the market to be more informationally efficient than it was before. So here in the diagram, it's just showing the interconnection. So that means if you come to a conclusion, the market is strong form efficient, so if that's your conclusion, then by definition it's also semi-strong and is also weak form, by definition. If you come to a conclusion the market is semi-strong efficient, then by definition it's also weak efficient as well, because these are levels or layers, if you like, of efficiency. So I'm going to look at the three cases and think about a brief consideration of how you might test it, what kind of test might you do, and what kind of evidence do we know about that type of efficiency based on, proper studies of this subject in terms of looking at the market data in the context of this hypothesis. So we start from a weak form, which is the lowest threshold or the lowest barrier to exceed, if you like, if we're going to accept the hypothesis. So here, remember, we're talking about the past price information, and therefore today's prices shouldn't be able to predict the future movements. That's what we're saying, really, as an interpretation. And if that's the case, the type of rules that you see used by technical analysts, so they have many hundreds of different trading strategies or trading rules they would apply by looking at the diagrams, the charts, or the patterns. So there's hundreds of them. And you can see some discussion, obviously, as I said here, Katkatsan and Nietzsche, chapter 17. So essentially, you could test those strategies on the past data and see would they have been successful. So that's the bottom line here. You can test these kind of trading rules on the past data and see did they work or not. So that's like a hypothetical test. Or you can test the correlation of prices. So if there's a positive return yesterday, does it mean a positive return today and a positive return tomorrow? So what kind of correlation would that be? Yesterday's return is positive, today's is positive, tomorrow's is positive. Positive correlation, yeah. Or similarly, if it was negative yesterday, positive today, negative tomorrow, negative correlation. Okay, so we've spoken about correlation before, where we've thought of two variables, obviously, and the two variables have been different assets. Here, the correlation is slightly different because we're referring to the two variables as today's price and yesterday's price. Those are the two variables. So we would also call it serial correlation. So if you have a strong correlation between the past prices and the current future prices, then that will be predictability. If you've got past returns that predict future returns, if past returns are high, that means the next returns are high. Correlation implies predictability in the context of this weak form efficiency. So the weak form efficiency, the tests, I come to a dramatic line at the top. The weak form is generally supported by the evidence. So where does that statement come from? It comes from many thousands of studies that have been done. You know, the hypothesis goes back to 1970 and maybe even earlier in terms of the ideas behind this. So you have hundreds and possibly hundreds of thousands of academic studies testing the weak form hypothesis, and generally they will say you can't just look at pictures and predict the next return. You can't just look at the price trends and have above normal profits based on those signals or on those strategies. So that's in general, but of course there will be exceptions to that. Where there are cases which have shown technical analysts can work or it can be successful. So my statement generally means obviously the majority of studies, or even the vast majority of studies, suggest it's not that easy. You can't just look at past prices to create a trading strategy that will, consistently give you above normal profits. There's another point of logic here. If you have some simple rule which says, okay, the price has gone up for 3 consecutive days, tomorrow it will go down. Okay, if you have some rule like that, which is a very simple technical rule, if we know that works, how many of you would be doing it? Everybody will do it. If everybody does it, what will happen? Stop working. End of the matter. So, there's a logical issue here. Everybody can look at the chart of prices. It's not some highly sophisticated PhD level skill. We can look at graphs. Most of you can look at graphs, I'm sure. And if there's a simple strategy following from that, we'll all do it because it's so simple.
Investors are not sophisticated. They don't know how to read charts. They know an analyst to tell them whether to buy or sell a certain stock. So, in order for them to invest, most analysts, they tell them what they want them to know. Like they would tell them that let 20 investors buy a certain stock, and then the price would fluctuate. They want them to fluctuate, and then they would buy it themselves. That's how it works, and that's why certain people are making high profits over there. So I don't think this is quite relevant for developing markets where the markets are not efficient.
Yes, there's a number of points. It's a very good question and issue that you discussed. The first point is, like I said, markets are not all efficient. That's not what I'm claiming at all, and the efficiency will vary over time. Yes, you've got sophisticated investors, and you've got what we would call naive investors. In other words, they haven't done their homework, if you like, and they're just using some extraordinarily simple method. So the sophisticated investors will make profits from the naive investors, no doubt. Okay? But the question is not that really. It's not, can sophisticated investors make money out of naive investors? It's, do those sophisticated investors produce above normal profit for 10 years in a row? Yeah? And that's not sophisticated versus naive. That's one sophisticated against all the other sophisticated ones. So that's one issue. Another point in response would be, when I say generally supported here at the top, those studies that I refer to, yes, there will be studies based on London Stock Exchange, but most of these studies are on emerging markets, in fact, because that's where people would expect to find what you say, which is lower levels of efficiency, perhaps. Yeah? But even so, hundreds of those studies really struggle to find how you can use past prices to consistently get above normal profits. But I'm not saying, that that's impossible. I'm saying the majority or the vast majority of studies would support that idea. Not every study would support that idea. Yeah. So, there's plenty of market participants, professionals using technical analysis around the world, all around the world. They believe in it. Many of them do well. So how do they do well? Well, yes, they could be more sophisticated. They're not using simple rules based on the charts. They're using quite complicated rules based on the past prices, not necessarily very simple ones. And then a more substantial point from our point of view, an academic point of view, is if there's some trading profit or some anomaly, it may not disappear immediately. So you may have a period of time where you can profit from that strategy, and then other people find out about it. Okay? So you might have a window of opportunity where such a technical rule can work maybe for 2 months, or maybe for 6 months, let's say. But eventually it will become known, and it will disappear, or else there will be some kind of arbitrage that will be exploited. Supply and demand will then remove the arbitrage profit. So the second one is semi-strong, and here we're talking about all the public information, which includes macroeconomic news, political and accounting news. And here we're saying when there's an announcement, like when the inflation data is released, if there's a market sensitivity there, the market will react immediately. Okay? So if we have the company profit being announced, the market reacts immediately. Or if the dividends have gone up, the market will react immediately on that news. So also, it's saying it won't over or underreact. I will come back to that when we talk about the anomalies, because there is evidence of underreaction and overreaction we can point to. So how do we test that sort of thing? Well, broadly we call it event study. Event study. What's the event? The event might be inflation news has been released, or the event might be companies are reporting their profitability, or the event might be elections. So all the categories we mentioned before. So these kind of studies will look at what happens when the news comes to the market. Because, a very precise timing we can identify as the event. And in doing that, we have to think back a bit to last week and the previous week, because we will need to think about the expected return. What did we expect to happen if there was no news event? Because what we're interested in is the abnormal or the excess. We're not just looking at the return, but the abnormal return. So we will have an expected return coming from CAPM or coming from one of the models we spoke about last week. So maybe we'll be doing financial research seminars next June, and that's one thing we'll study in some detail is these event studies. But when you think price adjustments are fast, so if you think of the more developed markets, the more developed stock markets, so the currency markets in particular, we might say, even more so, how quick do you think it is? How fast do you think it is? There's a piece of inflation news which will be released at a very strict time, and nobody will know it before precisely 9:30, let's say. So how quick do you think the price will change? Will it be in the hour? Or will it be next day? Will it be 15 minutes? Seconds, okay? Seconds is getting closer. Less than a second. Less than a second is getting closer, yeah. So, think back a few years, it would be fair to say 30 seconds or 40 seconds. I've got my own research from the 1990s where it was saying it was that quick in the 1990s. Now we've got what's called high frequency trading. So these traders working milliseconds. So it's not the brain which works out the price move, it's obviously a computer program that works out what will happen. We can't work fast enough to make a profit from these kind of news. Our brain is too slow. All of us put together would be too slow. You have to see the news and you have to have a program that will implement the trades. And that will be in fractions of a second. Otherwise, in many cases, you've missed the profit opportunity if you haven't done it in milliseconds. So you have trading firms who are investing millions or even hundreds of millions to improve the electronic communication. So it's about, physical cables that matter, not the brain. The brain is in the computer programmer, not in, reacting to the event. It's the computer reacting to the event. So again, we can make a sweeping statement, again, not just about developed markets, also about developing markets that is generally supported. In other words, like I was saying, sophisticated traders in international markets, they cause prices to change very, very quickly indeed. There's hundreds again of academic studies to support the fact that when there's news, the price will jump immediately relatively few opportunities that there will be, including in emerging markets, where you can simply see the accounting news and then be able to make some kind of profit immediately afterwards. Very, very few opportunities for that. I'm not saying none by any means, but proportionally very few. Okay, then we come to fundamental analysis here, because those are the type of traders who would be setting up such a computer program to trade so quickly. They must be able to analyze what will the effect of higher inflation or lower profits have on these asset prices. And that's in chapter 16 of the textbook. Detailed point here, if we are using the expected return, and then we're looking for the abnormal return, our answer for the abnormal return depends on how good is the expected return. So we're then testing two things. So we're then facing this so-called dual hypothesis problem, which is to say, we'll take one of our pricing models from the last 2 weeks, and we'll use such a model to say what the expected return is. But already we depend on, is that model good or accurate? And then we ask the question, the second hypothesis, do the returns react more than the expected return? So the detailed issue there, the dual hypothesis that you're testing, two things, not one thing. Okay, finally in this section, the strong form of efficiency. Obviously here we're talking about inside or private information particularly. So this is much harder to test. How would you test whether someone used insider trading? That's much more difficult to establish. Of course, regulators have to be sophisticated to detect those things. But from the point of view of trying to have some evidence, it's quite difficult compared to the other two forms. So a good example might be looking at fund managers and asking, can they outperform? Can they outperform persistently? Because the fund managers will try to have some private information as well. They'll try to create private information. I don't mean inside information, but they research, the quality of analysis they try to do will be kept private. They're not going to publish everything they know. So if they have some extra advantage, and obviously they have teams of professionals with experience, PhDs and so on, if they can't outperform, then that says something also about the efficiency of the market. So this is not so widely supported, of course. That's what you would expect as we move through the more challenging threshold of our hypothesis. Is harder to prove, if you like, or it's harder to support. So here, like was mentioned, why have we got insider trading rules if this strong form efficiency holds? Of course it doesn't hold very often, in fact, There's always going to be a chance for somebody to abuse the market or for an insider to profit. If we think about other professionals or sophisticated participants, analysts, their forecasts tend not to be systematically superior. You can't just follow some analysts and find you always get above normal profits. Similarly, mutual funds, you can't see the same mutual fund outperforming year after year. Otherwise, everyone would have put all their money in the same fund, wouldn't they? It doesn't happen. There are, of course, a small number of what you might call star fund managers who seem to do much better than their peers or competitors, but they're very few in number, very few of them. So we can't claim, markets are strong form efficient. That can't be a general statement. But we can say, many markets, most of the time, would be approaching semi-strong form of efficiency. But, be careful, the wording I'm using is most of the time. I'm not saying all the time. I'm not saying the the evidence is so supportive as that. And we'll come back to the anomalies in a moment to reinforce that. Okay, it's time for the break now. So they serve other purposes. Yes, you might say, yes, they want to achieve the best possible returns or profits. Yes, they want to have good returns relative to risk. But they also have other objectives. So, for example, in the UK, if an individual contributes to their pension fund, they get some other advantage. They get a tax advantage, for example. Okay? So if you put money in a pension in the UK and many other countries, you get a tax benefit from doing that. So in other words, the government's encouraging saving into a pension fund by giving a tax advantage. Okay? Here we've got some other cases, the portfolio diversification. You're going to go on, some of you, to manage portfolios based on my teaching, I'm sure. And, you will have expertise that some investors don't have, or some of your clients don't have. So they're buying that experience and expertise as well, not just the objective of above normal profits. Also, hedge funds, specific risk and return profiles. You and me can't do short selling. You and me can't do the leverage positions that hedge funds can do. So those kind of fund management services can do things that we can't as an individual investor. So there's many reasons. I spoke about tax as well, and there may also be regulatory reasons through which portfolio managers do more than just try to outperform the markets for their clients. So the question will arise then, will they do it in an active way or a passive way? So some of you are active and some of you are passive. Usually the active are nearer the front, not always, but usually. And usually the passive, not everybody, but usually the passive students are nearer the back. Not a direct relationship, but there's a tendency, shall we say. So if you think about investing then, what does active investing mean? You want to beat the market, yes. Okay, that's the best summary we could give. If you're labeled as an active investor, you have this objective that you want to try to beat the market. You want to try to do better than average, in other words. You want to be better than average and you want to attract clients to your fund, to invest in your fund, thereby you get more revenue and so on. So that's active. So you'll be following the ideas we're thinking of, like fundamental analysis and technical analysis, if you're an active investor. So what will you do then if you're not, if you're the passive one? Buy and hold, yes. So you're not buying and selling all the time if you're more passive. You're not asking questions, you're sitting at the back, yeah. You're trying to follow a benchmark, yes. So you could say you're trying to be average, in fact, yeah. So what's the benefit of being average rather than trying to be above average?
Minimize the risk.
Minimize the risks, definitely. Okay, so if you're trying to be average, what will your beta be? Cap-end beta? 1. The average beta is 1, so you will be at a beta of approximately 1. If you're active, what's your beta likely to be? More than 1. So if you're active, you're likely to take more risk. If you're passive, you're going to try to minimize risk. What else would characterize the passive ones? Less trading. You said buy and hold. If you're doing less trading, what else is less? No, not necessarily. No. The expected return is the average, basically, or the benchmark. you do less trading, what else will be less, apart from less risk? Not necessarily less profit, we don't know that yet. What do you do when you buy and sell? What happens?
Fees.
You have fees, yeah, and you have costs. Yeah. So if you're passive, you keep down your costs in many, many ways. If you trade less often, you pay less commission, you pay less bid-ask spread, you pay less costs. And if you're going to need to benchmark, that's much easier in terms of staff costs, in terms of management costs, in terms of transaction costs in general. Okay. So a passive fund manager is accepting to some extent the efficient market hypothesis. I'm not saying they believe it's strong form efficient, but if you're passive, you believe, at least you believe it's difficult to beat the market and it's difficult to be better than average. So instead of trying to be better than average, you aim for average or a benchmark. And by aiming for average, you can keep your costs very, very low, and you can keep your risk well under control as well. If you're active, you believe you can outperform, you believe you can beat the market. If you're going to try and beat the market, you're going to incur lots of costs and potentially lots of risk, but at least higher than average risk. Okay. So this idea of passive investing is consistent with efficient markets hypothesis. It's also consistent with the CAPM that we previously developed. So that's what I'm saying on this slide really, especially at the bottom. If you believe in efficient markets as we set it out before the break, I don't mean you believe in strong form necessarily, but you believe that prices reflect the information in general most of the time, then you might start to believe it's better off following a passive strategy. So you refer to benchmark. Well, we would often find the strategy, in fact, is to track an index. Okay? You can find plenty of funds around the world which are doing that. They're simply aiming to follow the market, not to be above the market return, but to follow the market return. Okay? And some quite influential people think that's a good idea. Okay? Warren Buffett. Who's Warren Buffett? One of the richest guys. Yeah. I'm not sure where he ranks, but he's definitely in the top 10, isn't he? In the world, yeah? So, what does he think? He might know something about investing. So, one day he'll die, and he tells his wife to put 90% of his money in index tracking fund. Right? So, follow a passive strategy. That's what he's saying, specifically quoting here. I believe following the index will be superior to most investors. So in other words, most investors will not do better than following the index. Setting up a portfolio that will track the index. So that's very much in line with our market portfolio in topic 4, and very much in line with the idea of efficient markets. He's not putting 100%, 90%. So he has some belief that it's difficult to beat the market, difficult for most investors. Obviously, he has succeeded personally. Maybe he doesn't have faith in other fund managers to do as well as him. But whatever, he's not putting 100%, so he's not suggesting his wealth should go 100%. So he has some doubt about efficient markets, obviously. But he also has some belief in it. Okay. And here's going back to my point, high fees. If you try to beat the market, you're going to incur high fees. If you try to follow the S&P 500 index, you're not going to have high fees. It's very, very easy to set up on an automated basis. Just write some programs, set some criteria, parameters, and leave it to on its own. You don't have to do anything. Just tracking the index. Another case here, exchange traded funds. Now this is bonds. So assets managed are 440 billion as of the end of last year, or this time last year. So several active funds are losing money from investors, and passive funds are gaining a lot of that money. So we've seen this happening, quite a lot in the last 20 years. Okay, it's not a consistently upward trend for passive funds, but broadly the trend is more investors have got faith in passive funds and fewer, well, I wouldn't say fewer have got faith, but more investors are questioning what you actually get when you pay a high fee to an active manager. That's a better way to express it, I think. If you are going into a passive fund, you might pay half of 1% as the management fee. If you go to some active funds, you might pay 2%. It's a lot of your money in comparison, 0.5 versus 2%. If you go to some hedge funds, you pay 20% plus a portion of the profits. So there's many wide-ranging fees that you pay to different fund managers. But passive fund managers, low fees. In the UK, another example here. But basically, my point is there's a lot of debate about the fact that active investing, trying to beat the market, is expensive and very often unsuccessful, whereas passive investing is regarded as very low cost, very low risk, and performance is defined by the benchmark. You're going to be average. That's what you're going to do. So clearly, there's some interesting points there, but you have to remember this is linked to the idea of efficient markets. If you thought there was no connection between information and prices, you'd never put your money in a passive fund. You must have some good belief that prices reflect information. Otherwise, you wouldn't put your money in a passive fund. $440 billion in bond passive funds mentioned there. A lot of people believe there's a strong connection between information and prices. Therefore, people don't believe there's no connection between information and prices. Okay, so summarizing the previous evidence before the break, we think, semi-strong efficiency is applying in a lot of markets a lot of the time. But now we come to a paradox here. Paradox. Not sure how to define paradox. What I mean there is the active investing is keeping prices efficient. Yeah? It's technical analysts and fundamental analysts who buy and sell in a way that brings the price to the equilibrium. And they're active investors. The passive investors don't contribute to the price discovery, but they're just followers. They're following, they're not creating, if you like, they're following. So we can't have a situation where everybody is passive. If everybody is passive, the paradox is the market will definitely not be efficient anymore. Yeah? Because nobody's paying attention if they're passive. If everybody in the room is passive, everybody's going to fail the exam. So I can't have everybody being passive. So we need some portion of people who are active, who keep the prices efficient, because they're looking for the profit opportunities. So we have to have a balance between active and passive, just like we need in the classroom. If everyone's active, if everyone asked me 5 questions every hour, we wouldn't get very far, would we? So there must be a limit to this balance between passive and active. Okay, now we come to the section called anomalies. So anomalies meaning something of a different point of view. There we came to the conclusion, well, a lot of people believe markets are relatively efficient, not absolutely efficient, but relatively efficient, and therefore they choose to invest in a passive way. Here we got some examples which would really be, strongly contradicting a passive investor, yeah, because these are examples where you could have made good above normal profits, or you could say, from a different point of view, these are examples which the efficient market hypothesis can't explain, or they don't fit with the efficient market hypothesis. And that's why they have the title, anomalies. So this is very much connected to the evidence. Previously I summarized some of the evidence. Here are some more detailed examples of the evidence, and some of it is very much predicting the hypothesis of efficient markets. Okay? Now, again, this involves hundreds of academic studies and studies by practitioners. So again, I'm just giving you a window on the whole subject, really, and also your textbook will give you more detail on several of these. You can certainly see in the past exam questions, quite often they may be referring to anomalies, or they may be more specifically asking for a discussion of some of these in the past exam papers in section B. Obviously, you can have a look at that yourselves, exactly what a question might look like. So we've spoken about speculation way back in topic 1, as well as other times, speculative bubbles, firm characteristics, seasonality, momentum we talked about last week. We didn't really explore it very much, but we did mention momentum last week. Overreaction, and momentum is effectively an underreaction, so we've got underreaction to news, overreaction to news, and then we've got international diversification, which really is lack of international diversification. So when we go through these, we'll start to see that we struggle to explain them on an efficient or rational basis, and sometimes we might be able to explain them on a behavioral or irrational basis. Yeah. So although it's still mainly thinking about efficient markets, we're also going to see some of these points giving hints forward to the behavioral ideas as well, okay? Because there can be some behavioral explanations to some of these so-called anomalies. So the first one is speculative bubbles, and I'm sure many of you can think of some cases, which was the one that we showed back in topic 2. Market going up, market dropping. When was that? Yeah, China back in June. The market dropped dramatically after a period of sustained speculation. Yeah.
The crisis time will go up in a specific point and then drop down.
It's not necessarily in a crisis, but yes, you can see, some of these bubbles when they burst, they cause a crisis actually, or they may be connected to a crisis, as you say, but in other cases, not at all. Neither is it connected to a crisis, nor does the crisis follow it. So you have all kinds of examples really. So what happens in a bubble like this is the prices get pushed up, mainly due to speculation, and then more and more investors see, the price is going up, I better buy. As there's more buying, price goes up more. All right, returns are good, we'll buy some more, and they keep buying some more. So we get a detachment from any kind of fundamental values. So we're getting a detachment from news in the sense that the prices don't reflect the macroeconomics, so the prices don't reflect the accounting situation of the firms. And then eventually it's so high that people stop believing. And people start selling, and then we have the tipping point then. Well, passive stack, that's a very good point. It's a very good point. And that's a major weakness of the passive style that we spoke about. You know, passive style is great if you're following the average and the average is going up. But if you're following the average and the average just drops, you are following the average down and you struggle to get out. Yeah. So that's a major weakness of the passive approach. And especially if you decide to become a passive investor right at the top, then, you know, that's pretty disastrous for you. Try to become a passive investor at the bottom sometime if you can. So this is very common, obviously, and we would say many of them are preceded. In other words, before the crash, you have a bull market. Bull market meaning positive returns, a very positive boom in the market, if you like. This is the stock market term, a bull market. What's the opposite then to the bull? The bear, yeah, the bear. Okay. So famously, we have 1929 and Wall Street crash and so on. Now, 1987, this is the one that embarrasses me because I can remember it and you can't. I guess. I'm not sure anybody in the room would remember 1987 very well. But this was a stock market crash with no real explanation, you know. It was in the middle of October, no great bad news, no significant explanation. UK, US, Hong Kong, many markets around the world falling by 20-25% on one day. Yeah. So that was not attached to a crisis. We didn't have a crisis after it. It was just a huge one-day drop, which people haven't been able to explain very well. At the time, there was a lot of talk about the program trading. In other words, the computer-based trading that I mentioned earlier. That's a long time ago, talking about computer trading. And now, more recently, you have things like the so-called flash crash, which you might have heard of, which is a crash within the trading day. Very big one in 2010 in the US. And, you know, there's a prosecution of that based on a single investor trading from his bedroom in London. Yeah? You can read about that. Flash crash. And you'll see they're trying to prosecute a British man. They claim he caused the crash from his bedroom in London. I don't know about that. Okay, the point that interests us in topic 6 is that, you know, you can't have a speculative bubble under the efficient market idea. The speculative bubble, by definition, is prices moving away from information. You know, prices are rising because there is misplaced positive feeling in the market. People are buying because other people are buying. You know, they're not buying because they have a positive view, or else they're buying beyond what is reasonable or rational. So eventually the market will correct. I suppose that's when the EMH returns, you know, into play, is when it corrects back down again. When we have bursting of the bubble, we could say is the time people realize, oh, prices are disconnected from information. Okay, then we have characteristic anomalies, and we talked about these last week in the way that they fed into the pricing models. So there's others, but the ones we spoke about last week were size, if you remember, in the Farman French model. Small minus big was a factor in the factor model. Similarly, the book to market value last week was a factor in the Farman French model. And then the last section last week, we identified dividend yield as being able to explain and possibly even predict the returns in the future. So This is a wider area where these other ratios would be referred to as anomalies, but these are the ones which we've mentioned last week as well in topic 5. So the point here is it shouldn't be so easy that you can just use dividend yield to predict the returns. You know, that's too easy. You know, it shouldn't happen. Okay, seasonality. This is something different that we haven't spoken about before, which is to say returns having a pattern over a particular time period. For example, systematically better returns on Mondays, or systematically better returns in January, or systematically better returns at the beginning of the day. So it could be even within the day, not necessarily daily or weekly or monthly effects. So the one I choose here is the January seasonality, and you can find a lot of research showing that the returns in January are systematically better than other months of the year. If you think rationally, you think about efficient markets hypothesis, that shouldn't be the case. Okay? It should not be the case that January is somehow having better returns than other months. Why? Well, one simple thing is, if we all know that, if we look at those studies and we know returns are better in January, what will we do? We'll buy them then, hoping to get those returns. Yeah? If we buy, what will happen to the price? Increase, and then when we sell, price will fall. It will correct itself, is the argument. Yeah? So, in fact, there's some evidence that has happened. Yeah? So there's some evidence that it was a temporary anomaly, if you like, and once people learn, the anomaly disappears. But very slowly in this case, very slowly. So therefore, maybe some other reasons. Can we explain it? Can we explain it? In other words, you know, this is just too simple. How could it possibly be true? You know, it was true. Historically, it was definitely true. That's not in doubt. But how could it be true? You know? The first point is tax loss selling. Tax loss selling could explain this in a rational way. In other words, there might be a good reason why January sees these higher returns. So in many countries, the year over which the tax liability is calculated would be the calendar year. Between January and December, you know, what gains did you make or what income did you make will determine how much tax you have to pay. So the argument of this hypothesis is if you see you've done well and you're going to have to pay a lot of tax, then you might decide you want to reduce that tax liability, and you might therefore realize some losses. You might have assets which have made a loss. You don't think they're going to improve next year, so if you sell them now, make a loss, you'll have less tax to pay. Okay? So what will it do if many people face that? If many people come to December and they decide I need to sell some assets to make some losses, reduce my tax bill, what will happen to prices? Price falls in December. These fund managers then have some cash that they hold. Come January, they put the cash back in the market, pushes the price up in January. So the change between December and January gets wider. In other words, the return in January gets bigger. So how could you say, is that true or not, or is that realistic? Well, take another country where it's not January, December. What is it in the UK? When do we calculate tax in the UK? In April, thank you. Yeah. So in the UK, there was an April effect. April returns are higher. So that supports the idea that tax has got something to do with it. So we might be able to explain it on that basis. Another case that might explain it is the window dressing. So we've talked about fund managers, and we talked about their performance, and we talked about if they perform well, more clients will give them money. Yeah. So quite often the performance will be again on the calendar year. Yeah, how well did they do in 2013? How well did they do in 2014? So they can in December decide, oh, before I get evaluated, I'm going to sell some of my mistakes. I made some mistakes this year. I will sell them in December. Lots of them are doing that. Prices go down in December, and then the fund manager puts the cash back in the market in January. That will have the same effect as this tax loss idea. So why window dressing? Who dresses the window? You're walking down the high street, the shopkeeper puts the best things in the window. Yeah? That's what window dressing means. Put the good things in the window so customers can see the good things. So what I just described is the fund manager putting the good things in the window. In other words, getting rid of mistakes from his portfolio. Yeah? So that's why the terminology of window dressing. So if these are, if these are valid points, then it's not really an anomaly anymore. Okay? Because if these are valid or true, these are rational explanations for a seasonal anomaly, we would say. So if these are true, then we dismiss it as an anomaly in that case. Similarly, over time, this has been traded away to some extent as well. So that's another indicator of some efficiency. So momentum, we briefly talked about it last week. This means positive returns follow positive returns, or negative returns follow negative returns. And even in the weak form of the hypothesis, EMH, that shouldn't happen, because that's predictable then. If you know that the recent return will predict the next return, that violates the weak form. Okay, so going back to one example of a study of this, taking the returns of the past 3, 6, or 12 months, predicting the performance in the next 3, 6, 12 months. Shouldn't happen under efficient markets. Okay, so this is saying winners remain winners. So risk doesn't explain it. So in a behavioral sense, we might be able to explain this as an underreaction. Okay, so if you see momentum, what could happen, or could have happened, is some good news. Instead of reacting instantly, the market takes a long time to reflect the good news. So you have positive returns following positive ones. In other words, there's a trend upwards instead of immediate reactions. Similarly, with bad news, the market underreacts, takes too long to adjust to the new price equilibrium. So there you would see negative returns following negative returns as an underreaction to the bad news. So there's a lot of evidence of this now in the last few years, the last 15 years in particular, of momentum. So that is really violating the weak form of efficiency, and a better explanation might be a behavioral one of underreaction by investors. So that is underreaction. Then we also have overreaction. So we see markets sometimes underreact and sometimes they overreact. So both of these are contrary to what the efficient markets idea would imply for us. So here we have another study. So the so-called losers, as they call them, then beat the market. So stocks which had a lot of bad news in the past, subsequently they bounce back, if you like. Whereas the ones that had a lot of good news fall down subsequently. So how could that happen? Well, if you have good news, the price has gone too high and then it corrects afterwards. Or if you have bad news, the price has gone too low and comes back up when it corrects. section will explain these kind of results that I got here. So these losers are doing better by 20% after 3 years, and they had lower risk. Doesn't make any sense. Doesn't make any sense according to CAPM or efficient markets. So a behavioral explanation is there's a tendency to overreact to the news, either to be too positive after the good news, or to be too negative after the bad news, and then there's a correction. So you can see the plot as of what I described is plotted in the textbook, figure 15.1 in the 2008 book. So the last one of this section, and we're going to have to finish the rest of the topic next time. The last one here, when we spoke about topic 3 and 4, I try to emphasize we're not restricting ourselves to the domestic assets or the domestic stock market. When we're diversifying well, we are looking globally even, but definitely internationally. So this is an anomaly in two senses, yes, for the efficient markets, but also from back in topic 3 when we set out principles of diversification. So the evidence is investors like to hold more of their home country assets. So they have a disproportionate weighting in home country stocks or home country bonds or their own government's bonds rather than foreign government's bonds. So it's not to say they don't have any international assets, it's that they don't have proportionally weighted. They have bias to the home country stocks, home country bonds, and so on. Okay? So we could explain this in a rational way to say, well, the reason we have more domestic assets is because we have more confidence when we calculate the expected return and the risk and the correlations for what we're familiar with. Yeah? We can say with more confidence what is the expected return for the domestic assets than we can for many of the international assets. That might be rational reasoning, or behavioral reasoning might be simply to say they're familiar, not to say because we can estimate risk better, but rather because we know these companies, we're a customer of these companies or whatever. That's not a good way to form a portfolio, just because you know the name of the company. Okay, information flows, yes. So you might say you've got better information flows in your home country, but I think that's diminishing over time. Certainly that would be very, very true, historically, without a doubt. But I think it is diminishing in importance over time. We do have much better information about international markets than maybe 20 or 30 years ago. So again, even in the home country assets, there's a bias to the home region. Okay, so like saying a UK company, they're based in London, they're biased towards South of England companies, and they never invest in any company from North Wales. Okay? So local companies. Again, chapter 15. So not a problem, we're out of time there because we can pick this up next time after the reading week. So this evening